Hello, everybody. At this time, we are talking about foreign exchange. Foreign exchange is the conversion of one currency into another. The foreign exchange market, or the forex as it is often called, is the global marketplace for converting currencies at their current values, which rise and fall according to changes in supply and demand. Not all currencies trade on the foreign exchange market. A nation may choose to peg its currency value to that of another currency, such as the US dollar. It may also choose to freeze its currency value. However, many countries float their currencies freely against those of other countries. This keeps the value of each currency in constant fluctuation against the values of other currencies. And then we move to the factors that affect foreign exchange rate. Many factors can potentially influence the market forces behind foreign exchange rates. The factors include various economic, political, and even psychological conditions. The economic factors include a government's economic policies, trade balances, inflation, and economic growth outlook. Political conditions also exert a significant impact on the forex rate, as even as political instability and political conflicts may negatively affect the strength of a currency. The psychology of forex market participants can also influence exchange rates. And then we move to the types of forex markets. The first, spot. The spot market is where currencies are exchanged between buyers and sellers at the current exchange rate. And then second, forward. The forward forex market is a easy market where two parties agree to trade a currency for a set price and quantity at a specified future date. These agreements are privately negotiated between the buyer and seller. And then the third, futures. Futures markets functions like forward markets but use centralized exchanges which protect traders against counterplay risks and after and offer standardized agreements rather than customizable ones. And then fourth, options. Forex options give participants the right but not the obligation to trade currencies at a given price and date in the future. These products trade OTC, with traders able to choose prices and expiration dates that suit them. And then, what are the benefits of foreign exchange transaction? The first benefit, trading 24 hours a day. The foreign exchange market is open 4 hours a day in different parts of the world. Thus, it is able to trade over a 24-hour period. is due to different international time zones. And second, relatively low transaction costs. The most important part of the transaction cost of foreign exchange is the price difference between bid price and asking price, which foreign exchange broker can earn during the transaction. Then third, high liquidity. Since foreign exchange transaction is fast to buy and sell, the liquidity is high and a large amount of funds can be quickly converted in a very short period of time. And then fourth, both rising and falling prices have profit potential. Since there are no restrictions on direct trading in the foreign exchange market, if you think a currency will appreciate, you can buy more. On the other hand, if you think it will depreciate, you can sell it immediately. And then how does Forex work? Forex operates through a network of banks, dealers, and brokers with the exchange rates constantly fluctuating based on the phases and forces of supply and demand. When you exchange one currency to another, you are essentially selling one currency and buying another. And then, what determines the value of one currency versus another? The value of one currency compared to another is primarily determined by the basic principle of supply and demand. Those are essentially treated as commodities subject to the forces of supply and demand. Consider the relationships between Indonesia and the United States. If US companies outsource services to Indonesia, they need Indonesian rupiahs to pay for those services. No, the relative demand for each currency determines its exchange rate. If there's a higher demand for US dollars compared to Indonesian rupiahs, the value of the rupiahs will depreciate against the dollar. A complex interplay of economic forces ultimately shapes the exchange rate observed in the foreign exchange market. And then we move to key participants in the forex market. There are the major players in the market. The first, commercial banks. Banks provide a lot of liquidity and are the backbone of the forex market. They trade, hedge, and speculate on behalf of their clients. And then second, money transfer companies. Over the past decade or so, alternative ways in the business of exchanging currencies have emerged. Many offer more competitive exchange rates than banks, helping them tap into the large market of foreign workers earning in different currencies and sending money back home. And then third, corporations. A company doing business overseas engage in the forex market, often daily. And then fourth, hedge funds. Many hedge funds speculate on future exchange rates. There are even specific funds dedicated to currency. And fifth, central banks. Central banks are in charge of managing a country's economy and money supply. Part of that involves altering how the national currency is valued. I think it is enough. Thanks for watching.